If you're a Canadian real estate investor who locked in a mortgage back in 2021 at around 2%, and now you're looking at renewing somewhere around 5%, this video is for you. And look, you're not alone. There are a lot of investors across Canada right now staring down that exact same situation. You're going from paying maybe $1,700 a month to something closer to $2,200 a month on the same balance. That's real money. That's money that has to come from somewhere. So today, I want to walk you through exactly how I think about this, how to analyze what your numbers actually look like after the renewal, what your options are, and how to make a decision that makes sense for your business. Because that's what this is. It's a business. And in business, you don't panic when the numbers change. You adapt. So let's get into it. Okay, let's just make sure we understand what we're dealing with here. Back in 2020 and 2021, interest rates in Canada were at historic lows. The Bank of Canada had basically dropped rates to the floor to keep the economy moving during COVID. So if you were buying or renewing in that window, you probably locked in somewhere around 1.5 to 2.5%. It was an amazing time to be borrowing money. Now we fast forward to 2026. Rates have come down from their peak in 2023, which, some of us were renewing at 5.5% and 6%, and some even higher. But we're still sitting in that 4.5 to 5.5% range for a standard 5-year fixed. So if you locked in 5 years ago at 2%, you are looking at a very significant jump. Let me put some real numbers on this so it's not so abstract. Say you've got a $400,000 mortgage and that balance is coming up for renewal. At 2%, your monthly payment is roughly about $1,700 a month. At 5%, that payment jumps to over $2,600 a month. That's a difference of over $900 a month on one property. So if you've got 3 or 4 properties renewing, you can see how fast that's going to add up. Now, and I want to say this clearly, this is not a disaster, but it is a situation that requires a plan. And if you don't have a plan, that's when it becomes a problem. So the very first thing you need to do before you call your broker, before you do anything else, is you need to sit down and you need to run your numbers. And I mean really dial them in. Pull out your rental income for each property. What are you actually collecting every month? Now look at your expenses. Your mortgage payment at the new rate, your property taxes, your insurance, your maintenance budget. And when I say maintenance budget, I always say to set aside at least 5% of your rental income. That's not optional. That's just good business. You need to be prepared for any maintenance issues that come up. Now here's the question. Does it still cash flow? Maybe, just barely. Maybe it's actually negative. And you know what? I've talked to investors who are panicking because they're going into a negative cash flow after renewal, and they think that means that they've failed. But that's not necessarily true. Real estate isn't just about monthly cash flow, although monthly cash flow is vital. But you need to take in the whole picture, the equity, the appreciation, the mortgage pay down, the tax advantages. So even if your cash flow tightens or temporarily goes negative, and I say temporarily, that shouldn't automatically mean that you sell. But you do need to know your numbers inside and out so you can make an informed decision. What I'd recommend is building yourself a simple spreadsheet or even just a piece of paper where you're looking at the current rental income, the new mortgage payment at say 5%, property taxes, insurance, maintenance reserve, that 5% that I told you about, and any property management fees if you're using a manager. Get that total, compare it to your income, and that's your starting point. So now you have your numbers. Let's talk about what you can actually do, and you've got more options than you might think. Let's start with option number 1. The obvious one is the first place I'd look, and that is, can you increase your rents? When was the last time you did increase your rents? If you've had a tenant in place since 2021 and you haven't been keeping rents at market, there's a good chance you're leaving a lot of money on the table right now. And I don't mean gouging your tenants, but I do mean getting your rents back to market rates. You need to know what comparable units are renting for in your area today. So check Facebook Marketplace, check Rent Faster, whatever other platform you use. And if your tenants are paying $1,400 and the market is $1,700, that gap matters enormously when your costs are going up. Just make sure you follow the proper notice requirements under your provincial tenancy legislation before implementing any increases. So option number 2 is add income streams. This is something I like to talk about a lot. Does your property have a garage? Does it have sheds? Does it have unused parking stalls or any unused storage options? If you're not renting those separately, you're leaving money on the table. I've added between $100 to $600 per month per property just by renting out garage stalls and storage sheds separately from the unit itself. That's not nothing. Every dollar counts when your costs are going up. You may also want to think about changing your business model on certain properties. Here's a good example. If you've got a 4-bed, 2-bath house and it's renting for about $2,100 a month as a single unit, have you considered renting it by the room instead? 4 bedrooms at $600 a month is $2,400 a month. And if one of those bedrooms has an ensuite, you're getting $700 for that room easy. So now you're looking at $2,500 a month on the same property. That's a $400 swing, right? It's a different management model and it's not for everyone, but if the numbers are tight after renewal, it's at least worth thinking about. The third option is let's reduce expenses. Go through your expenses line by line. Are you paying too much for your insurance? When's the last time you shopped it around? Is there anything in your maintenance or operating costs that's higher than it needs to be? There's always somewhere where there can be some fat to trim. And here's a big one that a lot of landlords overlook. If you've been including the utilities in the rent, now might be the time to change that. Either add a flat monthly utility fee on top of the rent, or better yet, have the tenants move the utilities into their own name. You'd be surprised how much that shifts things. Utilities are a significant monthly cost, and when you're absorbing them, your margins take a real hit. Just make sure you're doing this properly, with the right notice and in line with your lease terms and the provincial tenancy laws. Now, option number 4. Look at your renewal terms carefully. Are you automatically defaulting to a 5-year fixed? Maybe a shorter term, 2 or 3 years makes sense if you believe rates are going to come down further. Or maybe a variable rate makes sense for your situation. I'm not a mortgage broker and you should absolutely be talking to one, but understand that you have choices at renewal. Don't just sign whatever your current lender puts in front of you. You can also shop around to see what other lenders have to offer. And option number 5 is considering a value add strategy. If your property has renovation potential, so you have an outdated kitchens or dated bathrooms or tired interiors, this might actually be the right time to invest in some upgrades to get that market rent up or above even and reposition that asset. I've bought properties where the numbers didn't work as is, but after a renovation, they worked very well. Sometimes a tighter margin is the push you need to finally do the work that you've been putting off. And option number 6 is just simply to sell it. And yeah, I'll say it, sometimes the right move is to sell. Not every property is worth holding forever. If the numbers don't work at the new rate and you can't get the rents where they need to be and the property doesn't have a viable value add angle, then maybe you need to redeploy that equity somewhere else that it makes more sense. There's no shame in that. That's just good business. So let me just tell you what I actually do in this situation, because I think hearing the real life approach is more useful than just the theory. First thing I do is I run the numbers on every property separately, not lumped together, but each one is individually, because each property has a different margin, different rent potential, and different condition. You might have one that works fine at the new rate, and one that's marginal, and one that's a problem. You need to know which one is which. For the ones that are marginal, I'm looking at what would it take to make this work. Is it a rent increase? Is it a minor renovation? Is it adding a garage rental? There's usually some kind of a lever that I can pull to change those numbers. For the ones that are genuinely a problem, meaning no reasonable adjustment gets me to the number that makes sense, I'm having a serious conversation with myself about whether to hold it or sell it. And if I sell it, where does that money go? Is there a better deal out there right now that I could redeploy that cash into? The thing I always come back to is this. Money in real estate is made when you buy the property. If you bought right, good location, below market value, solid value add potential, then a rate increase is uncomfortable, but it's manageable. If you bought at the top of the market with thin margins and assumed that the rates would stay low forever, that's a harder situation. And the lesson there is really about how you begin to analyze deals going forward. Always model your deal at a higher interest rate than you're actually paying. If it only works at 2%, that's not a good enough deal. And I want to just spend a minute on mindset before I wrap up, because I think this is actually really important. A lot of investors right now in Canada are really stressed, and I get it. Like, I'm going through the same things that all of you are. When your costs go up by $1,000 a month on a property, that's real. But I want to remind you of something. This is a long game. Real estate rewards patience. The investors who are going to struggle right now are the ones who borrowed too much, didn't maintain reserves, and relied on staying at 2 or 3% interest rates forever. The investors who put systems in place, kept reserves, screened their tenants properly, maintained their properties, those are the ones that navigate this and come out on the other side stronger. And if you haven't been doing these things, and you're one of the investors who are struggling right now, don't beat yourself up. But learn from these lessons and start implementing changes today. Because that's all you can do, right? Is just move forward. So buying a couple properties doesn't create financial freedom overnight. That takes years. But if you're doing this right and treating it like a business, making sound decisions, not panicking when the market shifts, you can build something real over time. So don't let a rate renewal shake your confidence. Let it make you sharper. Let it make you better at analyzing deals and maintaining and managing that property. Let it remind you why having reserves and doing thorough research really matters. All right, so that's it for me today. If you found this useful, give it a thumbs up and subscribe. I put out regular content specifically for Canadian real estate investors, and I'd love to have you along for that ride. And if you've got questions about your specific situation, drop them in the comments. I'd love to read about it. And if I get enough comments about a particular situation, I'll make a video on it. Thanks for watching. I'll see you in the next one.